Hello, friends. Welcome to our weekly podcast. Today, with us, we have Miss Manvi Prabhu, who is the head of fixed income desk at Anand Rathi, and she is going to help us understand how we should invest in our debt instruments. Hi, Manvi. Welcome to the podcast. We have heard of different types of bonds for fixed income investment. Could you help us understand how an investor could choose the right bond?
Hi Karthik. So yes, we have heard of multiple types of bonds like secured, unsecured, perpetual, sub-debt, senior, tier 2, floating, market linked, etc. And the list goes on. But today I will elaborate on bonds basis risk, namely secured and unsecured. A secured bond is a bond in which the issuer of the bond pledges an asset as a collateral in case of default. What this means in simple terms is the issuer at the time of issuance earmarks a specific asset like gold, real estate, etc. against that issuance, and in case of a default, the asset is sold and the bondholders are repaid. Conversely, an unsecured bond is a bond that is issued without any collateral, that is without any security, simply basis the company's balance sheet strength. So clearly, investors would ideally prefer a secured bond over an unsecured bond. But unsecured bonds will offer a higher rate of return than a secured bond given the higher risk. However, whether or not to invest in a bond, whether secured or unsecured, that should not be the only point of contention for choosing a bond. The investor must first understand the issuer risk and then decide on whether to go for a secured or an unsecured bond. You have PSUs like REC, PFC, who issue both secured and unsecured bonds. Now, if you believe the issuer is safe, you can choose to go for an unsecured bond for a higher return. Simply put, an investor must first prioritize credit or issuer strength and then drill down to the type of instrument.
Talking of secured bonds, DHFL had issued secured bonds. Did that insulate the investors?
So, Karthik, DHFL did issue secured bonds and they filed for bankruptcy. IBC proceedings are usually a long and time consuming process. A petition is filed with NCLT, an interim insolvency professional is hired, a committee of creditors is formed, a resolution professional is hired, a resolution plan is prepared which needs to be accepted by the creditors, which finally has to be approved by the NCLT. So, yes, secured bonds will get repaid basis the resolution, but the timeline is not certain.
After discussing secured bonds, is there any type of bond that could be safer than a secured bond?
Yes, the answer to that is a covered bond. Covered bonds can also be called bankruptcy remote bonds as they offer dual recourse to the investor. Now, what does that mean? In case of a normal bond, the investor can claim a recovery from the issuer in case of a default. But in case of a covered bond, the investor has recourse to the cover pool and the issuer. Now, what is a cover pool? A cover pool is a pool of assets set aside for this issuance, just like a secured bond. But here, these assets are set aside in a separate entity known as a special purpose vehicle, commonly known as a SPV, which is managed by a debenture trustee. How does this help? In case of a default, the pool of assets set aside for the issuance are sold. And if the cover pool does not help with full recovery, the investor has unlimited recourse to the issuer's balance sheet assets too as a financial creditor. Now let's break this down with an example. A gold loan financier comes up with a 2-year covered bond NCD of 100 crores, which carries an interest of 8%. He agrees to have a cover pool of 1.25 times the issuance in the form of gold loans, which makes it a cover pool of 125 crores of gold loans or assets, which are assigned upfront to the SPV, which is being managed by the debenture trustee. Now, the underlying loan quality becomes important in case of a covered bond. Because in case of a default, the underlying loan quality is what will determine recovery. So, the underlying loan quality can be controlled by additional conditions like a maximum loan to value, a maximum tenor on the loans, a minimum interest rate on the loans, and all of this makes the cover pool stronger in case of the default. If the issuer does not default, well and good, the SPV plays no role and the investor is repaid on the maturity date by the issuer. However, in case the issuer defaults, the gold loans that were set aside in the SPV, they will continue to service the bondholders and at the time of maturity, the loans could be sold to repay the bondholders. In case the pool does not suffice to repay due to deterioration of loan quality, the investors have an additional claim on the issuer's balance sheet, making it a more secure proposition than a secured bond. Usually, a covered bond is issued by a company that is lower rated to reduce the risk for the investor. Hence, it is always important to first assess the issuer and then assess the instrument's risk reward payoff.
Thank you, Manvi. It was wonderful having you on the podcast. So, friends, that's it for this week. Don't forget to tune in next week for yet another podcast. Thank you.